So we were discussing this weighted average cost of capital. I think we discussed the debt and preferred stock, which is pretty simple. You just have to see what is the interest rate that you are paying, divide by the cost of capital, and you get the percentage. Simple, pretty simple, right? No confusion is there. The majority of confusion comes in when you want to calculate the cost of equity, common stock, or your own money, right? The CAPM formula, as you see on the screen, is cost of equity is, there are two major verticals of the cost of equity. One is the risk-free rate. I mean, it's, you can try to understand it from the another perspective, that if you are investing your own money, let's as a, you assume you are the stockholder and you want to invest money into the company, you have few choices available. One is the government choice, where you are going to get the very small amount of money. Remember the treasury bills, 4% return, right? You have the other choice of debt, means bank, you can loan the money to somebody, you can give it, you can invest in the government debt funds, commercial papers. It's a debt, not a equity itself, right? So you can get a slightly higher percentage of premium return. So why you do that? Because there is a risk involved, right? And that's what we call is the market risk premium. That is still a risk. That is still not comparable, because you cannot compare the debt versus the investment into a company. So what you need to understand is how much risk I am taking, or what should be the premium that I should be making compared to doing the business with the government. I mean, I give the money to government and let them give me a risk-free rate, versus of running the business by myself, or carrying the risk of performance, carrying the risk of downturn, carrying the risk of economy, carrying the risk of economic conditions, right? So how much that should be. Plus I also need to see how my market behave in relation with the overall market, because there is a market risk, right? So the risk is denominated by the beta, which is called the equity beta, and multiply by how much, what is my risk compared to the other market, plus what is the risk premium in the market itself. So there are three aspects of it. One is risk-free rate, one is extra premium that you want to charge compared by investing into a share market, or you can say business world in general. Then you multiply that risk premium by your individual risk compared to the overall market risk. So there are 3 points. So the first point is the risk-free rate, which is simple. You take the government bonds as a proxy to the risk-free rates, you will get it, right? Simple. Then the second component, as you will see on the screen, is equity beta. So the beta, I tried to explain in the past, it will be covering your overall risk compared to the general market risk. So what the beta of 1 means, you are at par with the market. Market grow, your return grow. Market drop, you will also drop. More than 1 means you drop higher than the market or increase higher than the market. Lower than 1 means your performance will increase or decrease lower than the market in general by the ratio, right? A minus beta, if the market drop, you will increase. If the market increase, you will drop. So that's the meaning of the beta. Then you have market risk premium. So market risk premium, you want to see the historical returns in the market proxy. The market proxy you can assume as S&P 500. Normally in the US, S&P 500 is the most used proxy for calculating the risk premiums, calculating the beta, because they represent the entire market, entire industries of big size and small size, both. So the risk is very minimum in S&P 500. And that's why you would see the S&P 500 is giving a moderate return compared to the risk-free return. Calculating the market risk premium and also the beta, we use S&P 500 as a benchmark. So here's an example to how we use the relationship. Basically, you will know the risk-free rate, you will know the premium, you will estimate the beta, and then you will get your cost of capital, 10.8%, right? And also the another way of calculating the equity was to look at the current price and the dividend that they are getting in the past, plus the dividend growth rate, that is the cost of equity. If you remember, the dividend discounting model of doing the pricing. So we calculate the price by dividing the dividend from the cost of capital. Remember what was the equity formula? It was dividend divided by the 1 plus r, right? Dividend divided by 1 plus r, correct or no? So if you reverse the formula, you can also get the cost of equity by dividend divided by price plus g, the growth rate, right? So that is also the cost of equity. That's another way of cost of looking at the cost of equity. So normally, so the first formula is this one. Cost of equity is equal to risk-free rate plus equity premium into market risk premium. If this is mostly used when you have a equivalent company in the market, and this is the second formula to calculate cost of equity. So you can use this also. Normally you don't use either or, you use both and take an average, right? Whichever however you feel comfortable with. So you cannot say, oh, I use only this formula. No, you cannot do that. You have to use both. Here we are using dividend divided by the price earning, but here you can only use it only if the stock is listed on stock exchange. Then only you will know the price, right? If the stock is not listed on stock exchange, you don't know the price, so you cannot use this formula. But the first formula you can use if the company is not listed. So that's the difference between these two formulas. So here is an example of the cost of equity. If let's say price of the General Electric in a long term was average forecast growth rate is 12% and expected dividend is 0.9% with a price of 30%, what would be the cost of capital? So here is the cost of capital, 0.9 divided by 30 plus 0.127, which means 15.8%. So that will be the cost of equity itself, right? So that's how we calculate the cost of equity. Now estimating the cost of equity, just to compare both models and to give you a summary of capital asset pricing model and also the constant dividend growth model, the inputs are equity beta, risk premium and the market risk premium, right? And in the constant dividend growth model, it's the stock price, the current stock price, expected dividend for the next year and future dividend growth rate. So these are the key inputs that you need. Assumptions for capital asset pricing model is that you need to make assumption of beta and also the market risk premium, right? So that's why these two are the major assumptions. And also you have to assume that this is the correct model to use. In the capital asset pricing model, the current price is not a problem. The expected dividend for next year is the assumption, and the future dividend growth rate is also an assumption, right? So that is the major assumption that you have to make. Okay, and also you are assuming that the future dividend growth is going to be constant, is going to be fixed. Either it will not reduce or it will not increase. So both of the models are full of assumptions, unfortunately, but both of them will give you an indication of the cost of equity. The cost of equity fairly represent the return that shareholders expect the company to generate. Okay, if the company generate lower, normally the shareholders will move the money from them and put into another one, so reducing the stock price, i.e. increasing the cost of equity. So if we believe the market forces, the constant dividend pricing model would always reflect a fair expectation of the equity holders in the company. But the only problem is you need to estimate the growth rate in dividend and also the next year dividend. Let's calculate cost of equity. So assuming equity beta for Johnson & Johnson is 0.55. So what is the meaning of 0.55? If market growth returns are 10%, Johnson & Johnson will give you only 5.5. But if they drop 10%, the Johnson & Johnson will also drop by only 5.5. That's the meaning of this beta. The 10-year yield on treasury is 3% now, and you estimate the market risk premium to be at 6%. So what would be the cost of equity? Can you calculate? Now you know the formula. So it will be 3% plus market risk premium into equity beta. What that is? 3% plus 6 into the dividends are $2.8. The market price is 92 and dividend increase is 4%. First way of formula is 3% plus 6% into 0.55. That I think is going to be somewhere about 3.3 if I'm not wrong. So it will be 6%. And if you use the constant dividend growth, that is 2.81% has been the rate. And if the dividend expect at 4% increase per year, so means next year dividend is 2.8 into 4%, 1.04 divided by 92 plus 4%. So it's 6.3% and 7.1% dividends in a year divided by current price and dividend growth rate. So that's the two ways of calculating the cost of equity. One is taking the market risk premium, which is compared to the S&P 500 and risk-free rate. The other one is taking its internal factors, right? Current price and dividends and dividend growth rate. So they are both different. But what is the meaning of this difference, right? Which one you should use? From the investor's point of view, they will use this method, dividend divided by current price into the dividend growth rate, because that's what they expect, right? They know dividend, they know the current price, they can estimate the dividend growth rate, and they will say, okay, this is my cost of capital, correct, from their point of view. And if the company want to say, okay, what is my investors point of view for the cost of capital, then they will use it. The other cost, CAPM, is more on internal, more on a market risk, not on the company expectation or company specific prices, right? So this is more a general cost of equity in the industry, even though it has an equity beta. But equity beta again is just an assumption based on historical, that how the company's risk has been moving compared to the market, but it's not firm, right? It depends on, and also it's a company as a whole, not just only the equity shareholders. So this cost of equity is giving more on a general sense of the market conditions, not individual investor perspective. So company can use average of both. So 6.3% plus 7.1%, that comes to what? 13.4 divided by 2. So they can use 6.7% as an average. So that's how the cost of capital is calculated. Now, what does it make an impact in the real world? Now, if let's say the real life implication of this calculation or this exercise is really to try and gauge what is the risk in the project, right? What is the risk in the company, so that we can evaluate what rate we have to use for our projects. So internally, when a company is evaluating a new project to invest into a new company or setting up a new factory, all the companies, they have their own WACC, their own set of the weighted average cost of capital. So one company who has higher weighted average cost of capital may not be investing into a project where other company feels it more valuable, because they may have lower weighted average cost of capital, because maybe their beta is less, they don't have that much of expectation in dividend growth rate, so their cost of equity is lesser. So that's a difference. So the cost of equity will be different from investor to investor, from company to company, and that's why the weighted average cost of capital will also be different. Okay, now the WACC equation. So the overall WACC equation is return on equity into equity percentage, return on preferred exchange into preferred stock percentage, plus return on debt 1 minus tax into debt percentage. So that's normally the equity. So if you don't have the preferred stock, it will be only equity plus debt. If you calculate the General Electric, which we have already calculated in the past, if we are given the weights, their weighted average cost of capital comes to about 6.8%, which is 10.8% for equity, 4% for preferred stock, and 1.98% minus tax for their debt equity. Their weighted average cost of capital comes to 6.8%. Now this 6.8% will be used whenever they are evaluating any new project or any new investment. They needed to give the company a minimum of 6.8% IRR. If the IRR is below 6.8%, they will reject the idea. If IRR is above 6.8%, they will accept the project. That is the implication of this weighted average cost of capital. Now these things are falling in place for you guys. We calculated the cost of equity. Weighted cost of equity is simple. Weights are simple, right? Preferred stock and also the debt. Okay, these are the weighted average cost of capital for real companies. So this in the book the one that we are using as a reference, they calculated the weighted average cost of capital of many companies. So you can see that many companies are in the range of 5% to 6%, right? 4.8% for Hershey, Target 5, Storm 6, Starbucks at 7, ExxonMobil at 7, Apple is at 8, Boeing is at 9, AMD and Amazon are at 12.6% and 13%. And if you say why they are so high, some of the answers are some of the companies are using a higher debt percentage. Some are using 10%, 24%, 10%, 10%. Apple is using 10%. That's why their cost is low. Their beta is, many of companies beta is higher. The lower beta means they are not really risky compared to the general market conditions. So like Hershey is a chocolate company. Market is going down or up, they continue to sell the chocolate. So they are very independent from the market. So their weighted average cost of capital is lower compared to the other companies where they are more related with the general economic conditions, such as Apple, Starbucks, ExxonMobil, Microsoft, Apple. Boeing is even by higher than the market, means if the market drop, they drop further more than the market, and if the market increase, they increase more than the market. Similar ways for Amazon and AMD, their beta is higher compared to the market. So these are the real companies. In real practice, usually we use the net debt and the market value of equity in calculating the weighted average cost of capital. We never use the book values. As I explained earlier, the book values are not used in the weighted average cost of capital. They are always used the market values. And the risk-free rate are usually used by the yields of long-term treasury bonds, about 10 to 30 years. The market risk premium is, they are using about 7.7% in a normal circumstances until 2016. So since 1926, the S&P 500 has produced an average of 7.7% above 1 year treasury rates. And since 1962, the excess return is only 5% from 1962. So you can choose which way you want to use. Now, if let's say you are using 30-year bond, then the 5.5% makes more sense because it's 1962 onwards. We may also need to recalculate based on the current circumstances, since maybe 1980 or 1990 to now, and recalculate the market risk premium. How much is the market risk premium, right? So that's the average market risk premium that are being considered by the companies. If 1 year treasury is 5%, if for 10 years it's 3.9%. So it depends on the company which market risk premium they want to use. Actually, there are many methods. Okay, let's look at this example. So let's say the GE is considering an investment that would extend the life of one of its chemical facilities for 4 years. The project will require an upfront investment of 6.67 millions, a $24 million investment in equipment. Plus, equipment is going to be obsolete in 4 years and will depreciate via straight line method. Over the next 4 years, the GE expect annual sales of $60 million from this facility. Material costs are 25 million and 9 million respectively, and it has no net working capital requirement for the project, and it has pay a 35% premium. So if you put that all into the thing, $60 million sales, $25 million cost of sale, operating expenses at 9 million, depreciation is 6, so the EBITDA is 6.67 is the upfront cost. EBITDA is minus 6% and 2020 income tax is there, so they get the unlevered net income of 13 plus the depreciation and minus the capital expenditure. They get their cash flow at 28 millions minus 19 minus plus 19 plus 19 plus 19 and plus 19. It's a fixed $19 million income over the next 4 years, right? So since their WACC was 6.8%, you can always calculate value NPV of present value of project of extending 4 million. So that is 64 million minus 28, $36 million that will be added to the value of GE facility, and this will be added to the market value to see what is the incremental in the share price of GE, how much share price of GE will increase if we make this announcement. moment the GE makes this announcement that they are going to extend this chemical facility by 4 years, and they expect to make about $36 million in terms of net present value, immediately their share price will increase by that amount, by per share, right? So the market will automatically factor in whenever they are doing the next time trading, they will factor in the new prices already. This was the project for one existing project, right? Now let's assume if they are going to invest into a new company or invest into a new project or invest into a new facility, then the cost of capital for the new acquisition, or let's say is going to acquire the Nike, a company that is making the shoe. Nike face different market risk than GE, so they cannot use the weighted average cost of capital of GE itself. So what they need to do is they need to recalculate their weighted average cost of capital based on Nike's business, Nike's market risk premium. So the weighted average cost of capital will not be used to evaluate Nike, okay, because they are different projects. So whenever the companies are using a new business, they have to recalculate their cost of capital by using the new project's risk. So if let's say you saw Nike is using the beta is 0.51, cost of equity is 6%, cost of debt is 3.2%. so the weighted average cost of capital of Nike is 6% only. So they will not use the own weighted average cost of capital, which is 6.8%. They will use Nike's weighted average cost of capital, which is 6%. Then there are divisional cost of capital. Means let's say GE is not gonna buy Nike. They will just create a division internally which is going to be similar to Nike. Now in that case, they have to still use the market risk premium, the equity beta of the Nike. So they have to readjust own weighted average cost of capital again. So they would use Nike's WACC as a new division. So in that case, they will have two separate WACC, one for their own business line, one for Nike. To remember that whenever you are implementing or investing a new project, you cannot use the weighted average cost of capital of your existing business. You have to recalculate everything again because the risk in the different projects are different. By the way, I will create one assignment which is gonna be comprising of capital budgeting exercise and also calculation the weighted average cost of capital. Okay, now I have explained you briefly the capital structure is comprised of the two choices. One is either levered or equity only, or with a debt, right? And the choice of capital structure will not change the WACC in general, right? So let's look at a bit of more concepts here quickly. So the capital structure is the collection of securities by which the firm has raised the capital from the investor. So it can be equity, it can be the debt, or it can be the preferred share capital, or it can be anything else. Firm consider that the securities issued will receive a fair price, as the tax consequences, and entail the transaction cost, and also change future investment opportunities. So fair price means that because the cost of debt in returns are different, right? Because of the risk, debt is cheaper, preferred costs normally are slightly higher but less than equity, and then higher than equity. But in terms of tax consequences, debt has a tax consequence, you save the tax there, but with preferred tax you don't save, equity you don't save. Transaction cost, there is a heavy transaction cost in terms of debt because you have to pay upfront charge, you have to pay the commitment fees, you have to pay the issuing fees, you have to pay the commission, right? Preferred stock is also have a cost of issuing the stock, managing the registrar, issuing the certificates. Equity shareholders also have a cost, right? But that's a one-time cost. After that, you don't have to pay for entire year because you have to issue only one-time certificate. You have to pay broker to be able to sell your equity shareholders. So that are the different costs. So every choice of the security has different consequences, right? They have different costs. You have to pay a different cost for issuing different type of securities. So the capital structure across industries is different, right? A firm's debt to value ratio is a fraction of total value that correspond to the debt and is different in each industry, and it's vary because of the various factors how they want to read what they want to do with the debt. The debt to value ratios in various industries. So you can see some of them goes up to 30% of the total value. In oil and gas industries, the biotechnology, the software companies are the least debt because they don't need that much of cash. The heavy industries means the retail industry or tracking or trucking or the hardware facilities, healthcare, construction, they require more debt because they are capital intensive equities. Within the industry, debt to value ratio is sometimes different because of the way the investors are managers, the board is managing their business. With a higher debt, you can increase the value of the company. So that we have learned that because the debt has a lower equity, has a tax advantage, the ROI, return on equity, increase if you have more debt, right? So certain companies, they use debt to increase the return on equity or to increase the leverage or increase the asset efficiency ratios. Remember the DuPont analysis where we were discussing what was the asset multiplier, right? So asset multiplier means how many assets you can buy with the value of equity. So certain companies get involved with the debt just to increase the return on equity of the company. So in a perfect market, the capital structure is going to be fairly priced, no tax consequences, and the investment flows are independent of financing choice. So the perfect market theory says that if you are investing into a project, it doesn't matter where your money is coming from. It will be same cost of capital to assess the investment. So capital structures does not affect the investment decisions. That's the meaning of this theory. Let's say you have a coffee shop which you want to open that requires $24,000 to open. Your expected free cash flow is $34,500 at the end of 1 year, right? So given the risk, coffee shop should own 15%. So in that case, your NPV is $6,000. Now the financing part is coming. So how you are going to finance? If you finance by equity, the value of equity will increase is equal to the present value of future cash flow, right? Which is $30,000. So if you sell 100% of your equity, 30,000 now, and you invest 24,000 into set up the equity and you make $6,000 net. You make it now already and you go home. You don't need to run the business. That's called the equity financing. Now let's say you do a leverage financing. You take half of the debt, 15% at 15,000 only at 5%. You don't take the entire money, right? So cash flow at the end of the year is going to be 34,000 minus 15,750 because of repayment of debt. So net amount you are going to save is $18,750. Value of equity now will be 16,304. Total investment of 31,000. 16,000, right? So did you understood this last part? If we invest with the equity, the value of the company still remains at 30,000, right? With equity financing, value of equity is always equal to the present value of future cash flows, which is 30,000 now. So the future cash flow is 34,500. So value of equity is $30,000, right? So which means if you, let's say, want to sell this company now, means you set up at 24,000. The value of the future equity is 34,500 is you will receive at the end of 1 year, but the value as of today is 30,000, correct? At the rate of 15%. It means you can always sell your business at $30,000 and make a net profit of $6,000 now, correct? The other choice you have is you sell only half. I mean, you take a half of the loan. You don't sell 100%. You sell 50% only, means the equity gets 50%, debt gets 50%, but the debt is only at 5% rate of interest, right? So the total value of the cash outflow at the end of the year is going to be 30,000 minus 15,750. So means at the end of the year you need to pay 18,750, but your investment as of now is only 15,000. So if you look at the present value of 18,750, it's $16,304. If you add 15,000 of your own equity as well, the value of the company is increased to 31,304, right? So the value has increased from 30,000 to 31,304 because of the debt. So that is the perfect capital market. Normally value of firm will increase by the saving of the debt, due to saving of the debt. So that's the normal theory. But because the theory says that the value of the firm remains irrespective of your financing choice, financing with equity or financing with some equity and some debt is not going to change. So your cost of capital will increase. Usually this is how it should look like. Unlevered firm, you have 34,500. That 34,500 goes to the investors, and the present value is 30,000. That's the value of the firm. If the firm's asset are free cash flow of 34,000, now is dropped into two parts. One is equity, levered equity. They get 18,750, and the debt get 15,750. So they flow to the investors, right? Investors still receive the same amount, 34,500, but there are two different type of investors. So they say the value of the firm has to remain the same, whether you use this model half by levered equity and debt, or you use 100% equity. In this case, you are using 1.15 for both equity and debt, but debt is only at 5%. It means the cost of equity will increase from 15% to something else that will make it same at $30,000. A weighted average cost of capital will remain at 15%. So the cost of capital, the cost of equity will increase. Slightly confusing, right? Let's make it a bit easier. In both the cases, if I say that weighted average cost of capital will remain same, it's not going to be changed. It will not change at all. It will remain the same. So let's make it 15%, right? So when you are using only equity, the cost of equity is equal to the 15%, right? Because it's 100% equity, right? The second part is we are saying that as per the theory, the weighted average cost of capital still remain 15%. But only thing change is the weights now. The weight are 50% for equity, 50% for debt. The debt is 5%. So what would be the cost of equity then? If the total weighted average cost of capital is 15%, right? Debt is loan. So the loan is at 5%, which is 50% of the total capital, correct? So what would be the cost of capital for equity only? So if you put in the formula, so let's assume the weighted average, the cost of equity is X, right? So 0.5 into X plus 0.5 into 5% equals 15. So if you want to solve this, what would be the cost of equity? No, it's going to be different, because 15% is the same, right? Weighted average cost of capital is same, but the cost of equity will change. If let's say you put into a formula, into the weighted average cost of formula, and you assume you don't know the cost of equity, right? So if you put into formula 0.5 into 5%, that is 2.5. So that you have reduced from 15%. So that becomes 12.5, right? The weighted average cost, the cost of equity will increase to 25%. The cost of debt is only 5%, because the weighted average cost of capital remains same. So the cost of equity will increase if the debt portion increase also, right? Because the concept here is that weighted average cost of capital, i.e. the value of the firm, is supposed to be the same in both the scenario. They are not going to be changed, lever or unlevered, equity with debt or without debt, they will not change. The only thing will change is the expectation from the equity shareholders. The Modigliani and Miller, they were the two gentlemen who professed this theory, and they got Nobel Prize for this theory also. So they had a proposition 1, which says that in a perfect market, total value of firm is equal to the market value of free cash flows generated by its asset, not affected by the choice of capital structure. Means no matter what, your value will remain the same, whether you finance your project with the debt or you use your own money. That is their proposition 1. That is the effect of leverage on risk and return. But that's not 100% true. Here you can see in the coffee shop, the 50% of the debt, the cost of levered equity is increasing. If it's a weak business, then the cost of equity is negative, return on equity is negative. If it's strong, the equity is higher, right? Levered equity 15%, 40% and 10%. Return is going to be different. And the second proposition that he made was the cost of capital in levered equity is going to be affected by the debt portion. So this was the formula. If you put this formula, you will get the cost of return on equity. Unlevered return is equal to debt divided by equity into unlevered minus the cost of debt, which is 25% that we calculated in the past. So by that formula, the return on equity can be increased by increasing the debt to equity ratio. You have higher debt means your equity cost of capital will also increase by the increase in the debt to value ratio. But at some point of time, if you have 100% debt, that means your cost of debt will become equal to WACC. In that case, there is no cost of capital because it's zero already, right? That will never happen because as per another theory, if the debt increase to a more than 60%, then the weighted average cost of capital will start to drop because of the risk involved in the company already. You just need to remember the theory. You don't need to remember the explanations, because in real world there is a tax, there is imperfections in the market, and there are tax impacts. So in the interest deduction in the firm, so as per the real world, the debt portions increase the firm's value, right? By having more debt, your firm value will continue to increase by the debt amount. The value of the companies increase by the value of debt that they are taking, multiply by their tax impact. The value of the companies will increase only by the tax shield. So how much money they have taken on loan into the tax rate, so that will be the increase in their market value whenever they take a loan, because of the theories, because of the overall tax savings in the company.